Welcome back to the deep dive. If you're tuning in right now, chances are you're already connected with the One More Bitcoin channel, and we're really glad to have you. We're here to navigate some of the biggest, maybe scariest, certainly most fundamental risks facing the whole decentralized world today. Today, our mission, it's not just reporting a story, it's really about giving you the essential technical and financial context for a threat. Well, it's already sent a massive shockwave through the crypto markets. We are talking about the quantum computing threat, and we're digging deep into a really comprehensive analysis we found over on the One More Money blog. This piece detailed a, frankly, stunning $540 billion vulnerability and the immediate, panicked market crash that came right after.
Yeah, and this deep dive, it's crucial for any investor holding digital assets. It really moves beyond just abstract theory, doesn't it? It's about managing your portfolio risk, understanding why the market suddenly gets so volatile sometimes, and recognizing the immediate, absolutely necessary tech evolution that crypto needs to survive this, well, this quantum era.
Yep.
We really need to dissect the data here because the market, it's treating this not as some far-off worry, but as a critical variable right now. So the key question is this tech challenge a death blow to Bitcoin's basic security? Or is it maybe just the catalyst that finally forces the kind of aggressive upgrades the industry really needs anyway?
Okay, let's unpack the scale of this first. Because $540 billion, I mean, that's the number that really turned this from a theoretical risk into, well, immediate market panic. What exactly was the scale of the vulnerability they identified that triggered so much anxiety back in early October 2025?
Right, so the alarm was really sounded by a highly respected figure in the quant space, Charles Edwards, founder of Capriol. And he didn't just, speculate. He used actual on-chain analytics to quantify the risk in a way that, frankly, the market just couldn't ignore.
Okay, and specifically, what was the data point that was so alarming?
Edwards estimated that, get this, an astronomical 25% of all Bitcoin currently in circulation, that works out to about 4.5 million BTC, is held in addresses that are highly vulnerable to a future quantum attack. And crucially, because Bitcoin's price was near its all-time high right before this news broke, that vulnerability suddenly represented a staggering $540 billion in exposed capital.
Wow.
Yeah, that kind of figure, $500 billion, it instantly moves the threat from some academic paper to the front pages. Immediately.
That is just massive. And for our listeners, especially long-term holders, you really need to understand why these specific addresses, often the oldest ones, are such an open target for a quantum attack. What makes them so different from, say, a new address created today?
Well, they're predominantly what we call pay-to-public key, or P2PK type addresses. Now, the security mechanism they use, it was fine for classical computing back in the day, but it has this critical quantum flaw. You see, when a P2PK address is used, the user's public key is exposed. And the key thing is it remains permanently visible right there on the public blockchain. So once a quantum computer exists that can easily reverse engineer the private key from that exposed public key, and we'll get into how in Section 3 these P2PK addresses, they basically become ticking time bombs. They're openly advertising the info a quantum attacker needs.
And it's important to stress, right, that this 4.5 million BTC isn't just randomly scattered around.
Not at all.
It includes the oldest and most famous coins in the entire ecosystem. We're talking about the estimated 1.1 million BTC, widely believed to belong to Satoshi Nakamoto himself, the network's, pseudonymous creator. This introduces a far greater, more systemic risk than just financial loss, doesn't it?
Oh, absolutely. I mean, just imagine if a quantum attacker suddenly got control of Satoshi's keys and tried to move even a tiny fraction of that 1.1 million BTC, the consequences would be catastrophic. It's not just a $500 billion theft anymore. It's an existential crisis of trust for the entire network. Such a huge, unexpected movement of those coins could potentially destabilize the whole chain, cause absolute network chaos, and severely damage the underlying proof-of-work security model. You just flood the market with inaccessible stolen coins. It'd be a nightmare.
Okay, so Edwards' technical warning was the match. But what was the non-crypto event that acted like, I don't know, the accelerant? The thing that transformed this niche technical risk into a globally recognized urgent issue?
That was a huge piece of mainstream validation. The Nobel Prize in Physics awarded on October 8th, 2025. And the award specifically recognized the foundational work that enabled the current generation of superconducting quantum processors, the very machines being developed by giants like Google and IBM.
The timing was just impeccable and terrible for the market, I guess.
Exactly. Precisely. This really high-profile global recognition sent this loud, clear message to financial markets. Look, This technology is real. It's advancing rapidly from the lab into actual engineering reality. And that theoretical deadline for cryptographic obsolescence, it's moving much closer, much faster than anyone previously anticipated.
So that perfect storm, the technical warning, plus the global validation, it led to a specific timeline, didn't it? What was Charles Edwards' urgent call to action? When did he say these vulnerable assets must be secured?
He issued a really stark deadline. These 4.5 million vulnerable BTC must be upgraded and moved to quantum-resistant addresses before the end of 2026. This urgency, it really emphasizes that the threat has shifted. It's not some theoretical 5 to 10-year thing anymore. It's a necessary 2-year implementation window. The industry just cannot afford to wait for the hardware to catch up. They have to upgrade now to secure these assets against future decryption.
Right. Here's where we really connect the physics to the finance. The One More Money blog analysis points out the market was already fragile. It was, still reeling from that $19 billion forced liquidation event.
Right, the U.S.-China tariff thing.
Exactly. That squeezed global liquidity. So how did the market react when you layered this existential quantum threat on top of that existing high leverage anxiety?
Oh, the reaction was a classic shock and awe event.
Yeah.
And the severity was massively magnified precisely because of that pre-existing fragility you mentioned. The market had been really aggressive, pushing Bitcoin up to a new all-time high of around $126,800 on October 7th, 2025.
Wow, just the day before the Nobel announcement.
Correct. So as the news spread and kind of merged with that lingering geopolitical uncertainty, it just caused a rapid, really aggressive correction. The selling pressure was immediate, and because of lower liquidity and higher leverage, altcoins just got hammered, drops exceeding 20% in a single 24-hour period. The cascade was incredibly fast and brutal.
Let's talk data for a second, because this wasn't just a healthy pullback, right? This was a cleansing of speculative capital. The liquidation figures really define the panic-driven deleveraging that happened.
Yeah, the bias in the liquidation data was just overwhelming. Long liquidations totaled a crushing $16.686 billion. That represented 87.2% of the total liquidations during that period.
87%. Which means only a tiny fraction, $2.45 billion or 12.8% were short liquidations. That tells a really powerful story about market psychology, doesn't it?
It absolutely does. This was textbook, a severe, panicked, long squeeze. You had traders betting on the price continuing upward, many using high leverage, and they were just violently forced to sell their positions as the price plunged past their margin limits. The quantum threat basically served as the perfect negative catalyst to just liquidate that immense amount of speculative capital. It washed out the leverage bulls almost overnight.
And the selling didn't just stop there, did it? The fear kind of absorbed the initial shock, but then came this sort of psychological second wave about a week later, around October 14th. What happened then?
Yeah, renewed fear, continued deleveraging. It just pushed major cryptocurrencies further down. Bitcoin fell below that key psychological $110,000 level, marking another 4.6% drop. Ethereum actually suffered even worse, dropping below $3,900. That's over an 8% decline in the 24 hours following that secondary fear spike.
And the consequence of that second dip, more mass liquidations, I assume.
Indeed. In that single 24-hour period, another 206,600 traders were liquidated. Total losses just in that window amounted to $656 million. The sheer compounding scale of this financial chaos, driven fundamentally by a technical threat narrative, it just highlights how acutely vulnerable an over-leveraged market is to these non-traditional technological shocks like the quantum warning. The psychology of panic was just amplified by realizing that the core assumption mathematical impossibility was suddenly under threat.
Okay, to really price this risk properly, we have to move past the dollar figures for a minute and truly understand the physics and the math behind it. The market panicked that hard because the cryptographic bedrock itself could potentially shatter. So what is the fundamental cryptographic system that Bitcoin relies on, and what's its core security principle?
Right. The security of Bitcoin is fundamentally built on the elliptic curve digital signature algorithm, or ECDSA. Its security really hinges on how difficult a specific mathematical challenge is. It's known as the discrete logarithm problem, DLP,
Right.
but performed over these things called elliptic curves.
Okay, and how does that translate into the keys, the public and private keys, that a user actually interacts with?
Well, you generate a secret private key, which is basically just a very large random number. Then, from that private key, you use a one-way mathematical function to derive your public key. This derivation process is like a trapdoor function. It's really easy to go one way, private to public, but computationally infeasible to go backward, public to private. Current classical computers, Even the fastest supercomputers would need thousands, maybe millions of years to try and reverse engineer the private key just from the public key. That infeasibility, that's the core principle of digital ownership in crypto. That's the classical world.
Okay.
Okay, now let's introduce the quantum threat. Tell us again about the specific quantum algorithm that completely changes this fundamental reality. That would be Shor's algorithm. Now, unlike classical machines that basically rely on brute force, quantum computers use these strange phenomena like superposition and entanglement. Shor's algorithm leverages these quantum properties, essentially using something called a quantum Fourier transform to perform a critical step called period finding, exponentially faster than any classical machine could ever hope to.
So it's not brute forcing the answer. It's finding a hidden pattern that lets it kind of bypass the computational difficulty altogether.
Exactly. Shor's algorithm provides an efficient pathway to solve both the discrete logarithm problem and the factoring of large numbers, the very mathematical problems that ECDSA and also RSA encryption are built upon. What this means is that the cryptographic trapdoor function we talked about, it's effectively reversed by a powerful enough quantum machine.
And how does that translate into a direct catastrophic breach of Bitcoin security, especially for those old addresses?
Well, for those old PDPK addresses where the public key is already exposed on the blockchain, the vulnerability is total and immediate. Once the hardware exists, that is. A quantum attacker could systematically scan the entire Bitcoin blockchain, find these exposed public keys, run Shor's algorithm to derive the corresponding private key in potentially a matter of hours or even minutes, and then they'd gain complete undetectable control over all the funds in that address. The attack signature would look entirely legitimate to the network because the transaction would be signed by the correct private key, which was just mathematically stolen.
Okay, the One More Money blog analysis did provide some assurance that the hardware isn't quite there yet. What's the theoretical minimum requirement we need to be watching out for? How many qubits are we talking about?
Yeah, the general theoretical consensus suggests that a fault-tolerant quantum computer with roughly 2,000 logical qubits would be needed to reliably break the 256-bit ECDSA encryption that secures Bitcoin. And while we are seeing incredible progress from companies like IBM, Google, and others, current processors still fall short of that critical stable threshold. So yes, the threat is not yet instantaneous.
But this is a big but. The industry is sounding a really loud warning about a forward-looking attack that makes the immediate hardware timeline almost irrelevant to the security planning needed today. Tell us about the Harvest Now, Decrypt Later attack. This sounds perhaps like the most insidious threat vector.
It is. It's cold and calculating. Security experts are warning that sophisticated malicious actors think nation-states with very long technological time horizons and huge resources. They're not waiting for the hardware to exist. They are systematically storing vast amounts of public transaction data from the blockchain today. They know this data is useless to them now, cryptographically speaking, but they can hold on to this massive data set indefinitely, just waiting until a sufficiently powerful quantum computer arrives in the future. And at that point, they could potentially decrypt the entire stockpile in bulk, leading to a massive, coordinated theft of all stored vulnerable assets simultaneously. This completely shifts the timeline burden onto the network itself. It demands an upgrade before the hardware is mature, not after.
Okay, so the quantum threat is forcing this fundamental, maybe necessary technical reckoning. The One More Money blog highlights that the industry's reaction has actually turned this vulnerability into a catalyst for, well, an accelerated evolution in security protocols. The goal is achieving what's called cryptographic agility. What are the industry's two main lines of defense here?
Right, we basically have two tracks. There are immediate user-side actions focused on, let's call it, address hygiene. And then there are the long-term protocol-level upgrades that actually change the underlying mathematics.
Let's start with the immediate action plan for our listeners, address hygiene. What should every long-term crypto holder be doing, like right now, to minimize their personal risk?
The most immediate and absolutely critical recommendation is migrating any high-value funds out of those old PDPK addresses. We know the vulnerability lies in the fact that PDPK exposes the public key permanently. The solution: use modern address types like SegWit or Taproot, and crucially, adopt a strict policy of one-time use addresses. Never reuse an address.
That seems like a relatively small behavioral change, but why is using a modern one-time use address so effective against this quantum harvesting threat?
Because modern address structures, especially Taproot, use more complex scripting And, well, structures that deliberately delay or obscure the exposure of the raw public key until the transaction is actually confirmed and the funds are spent. So by never reusing an address, the public key only gets exposed on the blockchain after the funds have already been moved away from it. This dramatically minimizes the attack surface for harvesting. If an attacker harvests that data, great. But by the time their future quantum computer is ready to crack it, the associated address will already be empty.
Okay, that's the short-term mitigation for users. But the ultimate solution really requires a radical shift away from ECDSA mathematics entirely. So let's talk about post-quantum cryptography, or PQC.
Right. PQC refers to entirely new cryptographic algorithms. These are designed specifically from the ground up to resist Shor's algorithm. They rely on different kinds of mathematical problems that quantum computers, as far as we know, cannot solve efficiently. The leading contenders, many being standardized right now by NIST, the National Institute of Standards and Technology, fall into two main categories. You've got lattice-based cryptography that includes algorithms like Crystal's dilithium and Crystal's Kyber, and you've got hash-based cryptography, which is used by algorithms like Synthesis plus FES.
And these PQC methods, they rely on problems like what? Finding the shortest vector in a lattice. Things that are just incredibly difficult even for a quantum computer, is that right?
Precisely. They're based on hard problems in areas like multivariate polynomials or, yes, lattices, which are currently believed to be safe from Shor's algorithm. Dilithium, for instance, is a strong candidate for digital signatures, exactly what Bitcoin needs to sign transactions, because it's seen as robust and relatively efficient.
But implementing this, it's not really voluntary, is it? Not with a $540 billion risk hanging over the network. This leads us to maybe the most contentious part of the whole plan, the idea of a forced compulsory migration. The October 2025 proposal called for a hard fork that would essentially compel users to upgrade. Wait, freezing assets, even vulnerable ones? That sounds like a massive governance risk, potentially hugely contentious. How does the industry possibly expect to achieve that level of unified consensus in such a short timeline?
You've absolutely hit on the biggest difficulty, the governance challenge. Achieving consensus for any hard fork is notoriously difficult, as we've seen many times in Bitcoin's past. However, the argument behind the proposal is that the quantum threat is a uniquely shared existential risk that maybe transcends the typical political disagreements within the community. The plan involves setting a strict deadline, and the key mechanism to enforce compliance and prevent that catastrophic quantum theft scenario is the threat of the burn.
Okay, so what happens after that mandatory deadline if a user hasn't moved their P2PK assets?
After the deadline passes, the new, upgraded protocol rules would essentially dictate that any funds remaining in those old, vulnerable P2PK addresses would be effectively frozen or burned. They'd become unspendable. This compulsory migration is viewed by many key developers as absolutely necessary to eliminate the systemic risk entirely, even if it forces painful compliance, especially on long-term dormant accounts. The argument is pretty simple. Better to freeze the assets now than have them stolen by a quantum attacker later.
Let's zoom in on the highest risk assets. That estimated 1.1 million BTC attributed to Satoshi Nakamoto. Is there a specific strategy for those specific coins? Because moving them would be problematic.
Yeah, exactly. Recognizing the massive systemic risk posed just by the potential movement of Satoshi's coins, analysts like AMG Zero suggested a highly targeted approach. The proposal involves possibly placing a temporary protection period on these specific very early PTPK coins, maybe by freezing them outright or placing specific restrictions on their movement until they could potentially be securely migrated by some kind of multi-sig community effort, assuming Satoshi never resurfaces. The goal is basically to neutralize them as a potential black swan threat that could instantly collapse confidence and the market if those keys were ever broken by a quantum computer.
Neutralizing them. That sounds like a smart way to buy some time, at least. Okay, besides a complete protocol overhaul, are there other defense strategies being looked at? Maybe blending the old and the new cryptography?
Yes, absolutely. This is where hybrid encryption comes into play. Projects like Blockstream have already been testing a hybrid solution. This involves combining the traditional time-tested ECDSA signature with one of the new PQC signatures, like Sysvian plus Keter within the same transaction. This creates a kind of layered, redundant defense. So if a future quantum attacker breaks the ECDSA part, they still have to break the SFIN-CS plus signature, which relies on completely different PQC-resistant math. This sort of balance allows the network to gradually transition while maintaining security against both classical and quantum adversaries simultaneously during the changeover.
And finally, the One More Money blog also highlighted that this whole transition really needs to be orderly to avoid massive market disruption, suggesting maybe a phased approach.
This exactly. Organizations like BitMEX Research have actually proposed a comprehensive three-step phased plan for this. This kind of transition would allow the network to gradually enhance its quantum-resistant capabilities over a defined period, minimizing disruption along the way. This slower, more deliberate pace is pretty essential to ensure that the entire ecosystem, wallets, hardware manufacturers, exchanges, all the DeFi protocols built on top, has enough time to adapt, test, and fully validate the new PQC standards before they become mandatory network-wide.
Okay, so the market absorbed two huge shocks, the geopolitical tariffs, then the quantum panic, and then it faced renewed macroeconomic pressure on top of all that. What are the technical indicators telling us now about a potential recovery after all this extreme volatility?
Well, the recovery paths definitely got complicated again in November. We saw renewed macroeconomic headwinds, mainly pretty hawkish commentary from central banks about inflation and interest rates possibly staying higher for longer. This drove another sharp correction that actually pushed Bitcoin's price below the critical $100,000 psychological level for the first time in months.
Right. The analysis points to lows somewhere near $99,000 around November 5th, 2025. That November shock really confirmed that the prior area, around $115,000, where the initial quantum crash had stalled, was indeed pretty formidable resistance, didn't it?
It did, correct. But despite this continued fear driving the price lower, several key technical indicators are suggesting that the market might be starting to find a more structural bottom. We have to look really closely at the signs of seller exhaustion, especially when price breaches a major psychological barrier like $100K.
Okay, let's start with the relative strength index, the RSI. What does that momentum oscillator typically indicate when it dips that low?
So the daily RSI, which basically measures the speed and change of price movements, it dipped back into that deep oversold region. Now, when price drops rapidly and the RSI hits those oversold levels, it's often a textbook signal for renewed seller exhaustion. Crucially, the stabilization we saw almost immediately after breaching $100,000 suggests that aggressive dip buying is still active down there, absorbing those forced sales.
And what about the crucial signal of bullish divergence? This is always a favorite technical indicator for potentially signaling a cyclical bottom. Can you walk us through why this specific pattern is so significant right now in this context?
Absolutely. Bullish divergence is a really powerful sign that the downside momentum is weakening, even if the price itself is still falling. What we saw confirmed during that November price action was a pretty textbook signal. The price action carved out a new lower low that dipped below it under care. But key momentum oscillators, including the RSI, failed to print significantly lower lows alongside the price.
Okay, so price is falling, but the force or the momentum driving that fall is actually diminishing.
Exactly right. It indicates that the sellers who remain are perhaps weaker, or maybe the buyers are just stepping in more strongly at these lower levels. The divergence signals that the downward momentum is fading, and therefore a cyclical bottom might be forming, potentially paving the way for a reversal.
So if a technical bottom is potentially in, what are the critical levels investors really need to see reclaimed to confirm a major bullish continuation?
The analysis identifies the $111,000 to $113,000 range as the critical strategic support zone that must be reclaimed and, importantly, held. Then, to really confirm a robust recovery, we need to see a decisive move above that prior high, breaking the $115,000 resistance level. That's the level where the initial panic really set in.
And Dicello Roni of DC Capital, he postulated a pretty specific outcome if that $115,000 ceiling is broken, didn't he?
Yeah, Roni suggested that a firm reclaim of that $115,000 level would likely trigger significant buying momentum, potentially igniting something like a 15 to 20% rally fairly quickly. This move would likely be fueled by capital re-entering the market, perhaps accelerated by renewed inflows into the Bitcoin exchange-traded funds, ETFs, once confidence starts to properly return.
Okay, finally, let's just quickly connect this whole quantum challenge back to the fundamental strengths that continue to support Bitcoin's price, sort of independent of these technical and technological shocks.
Right. Because despite the unprecedented technological fear and these, looming governance challenges, the long-term picture really remains anchored by those core fundamental strengths. You've got the digitally enforced scarcity, that immutable 21 million coin limit. You have the predictable programmatic supply shock from the halving mechanism, cutting new supply in half every 4 years. Yeah. And you still have continued institutional buying through regulated products like ETFs. So the market, despite all the short-term volatility and fear, currently seems to be pricing the quantum threat more as a long-term concern, not an immediate crisis. It's using it perhaps as a necessary catalyst for evolution rather than treating it as a declaration of death for Bitcoin. Hashtag outro route.
So what does all this mean for you, the investor, trying to navigate this really complex landscape?
Well, the countdown is definitely on for the quantum threat, no doubt about it. But the solution framework, that BQC roadmap, it's becoming clearer. The industry is basically in a race against the exponential advancement of quantum hardware. The investors who are likely to emerge successful in this coming quantum era are probably those who take proactive steps now. So, based on the One More Money blog analysis, here are your 3 immediate tasks. First, immediate address hygiene. Seriously, migrate all high-value holdings out of those vulnerable P2PK addresses. Move them to modern, one-time use address types like Taproot or SegWit today. Just reduce your immediate personal quantum attack service. Second, monitor protocol upgrades. Keep a very close eye on the community consensus and the actual implementation of these PQC standards. This compulsory migration, if it happens, is arguably the single most important long-term value proposition for the entire asset class. And third, manage volatility.
Just recognize that future quantum-related news, maybe a new scientific breakthrough, maybe another analyst warning, it will likely trigger short-term volatility. Be prepared mentally and perhaps financially to use these dips as potential buying opportunities, provided the industry's response remains robust and seems to be on schedule.
Yeah, and that successful transition, it really hinges not just on the technology itself, but critically on achieving that unified community consensus for a mandatory protocol upgrade, for that hard fork. How volatile and potentially fractious will that governance challenge become when the 2026 deadline really starts looming large? That's the big question mark. Disclaimer. The opinions expressed here are for educational purposes only and are not financial advice. Always consult a qualified professional before making investment decisions. Thank you so much for watching. If you are interested in cryptocurrencies, RWA, DeFi, and Bitcoin investment, please do subscribe to the One More Bitcoin channel so that you won't miss out on the latest videos in the future. Also, please give us a like and drop a comment below so that we know what you think about this whole topic. We'd love to hear from you. Thank you for watching again.
See you in the next deep dive about blockchain, Bitcoin, and crypto.